also a tax strategist, and I've been in the finance industry for over 18 years. As a solopreneur, right, or someone who's an entrepreneur.
Hello, everyone. Welcome back to another edition of the Tax Takeover, where every week we help you navigate the ins and outs of taxes and maximize your savings through, you guessed it, the tool of tax planning, right? So, today we have another important topic. We're going to be discussing avoiding the gift tax trap. All right, so we're going to be exploring some tax smart options for transferring assets to your children. That's right, for the entire month of August, I said that we're going to be in a series where we're highlighting tax strategies around your children, all right? In celebration of back to school, that's why we're focusing on the children for the entire month of August, all right? So I said that in the beginning of the series, so I wanted to make sure that I reiterate it. So definitely right now, this is the time for you to share this video, tag someone who you know has some children, because they're definitely going to want to tune in for this episode tonight, right? So before we dive in, allow me to introduce myself for those who may be joining for the first time. My name is Samara Andrews. I am your resident tax strategist on the Tax Takeover and a fellow tax enthusiast dedicated to helping as many people as possible obtain wealth through the tool of tax planning, right? Here at the Tax Takeover, we know that tax planning is not just for the wealthy, but can be used as a tool to grow and protect your wealth, all right? You can start tax planning no matter where you are in your financial journey. And I'm going to show you how to get started in today's episode. So I'm glad that you are here, and please be sure to stay until the end because, as always, I share a bonus tax tip, right? So, when it comes to transferring assets to your children, it's essential to understand the potential tax implications, all right? Many people are unaware that there is a thing called a gift tax. Now, a gift tax is where the federal government imposes a tax on the transfer of money or property to another person without expecting something of equal value in return, right? But fear not, there is a range of tax smart options to help available to you to help you navigate this potential tax trap, right? And we're going to explore them together on tonight's episode, right? So we're going to start with the annual gift tax exclusion, all right? So the annual gift tax exclusion is under the current tax laws for 2023, you can give up to $15,000 per person per year without incurring any gift tax or needing to report the gift to the IRS. All right, so let me explain how that works, okay? So the gift tax is not imposed on the person that's receiving the money, but the gift tax is imposed on the person that's given the money. All right. So under the annual gift tax exclusion, the person that is giving the money can exclude or not even have to report that gift to the IRS as long as it's under $15,000. Now, if you are married, you can give up to $30,000 to any child or person without triggering any taxes. So you see how that works? So again, the annual gift tax exclusion is up to $15,000 per person per year, right? So if you're married, then that means it's two of you. So together you can give up to $30,000 without having to trigger the gift tax. All right. So I know this works because I was able to help a client use this strategy successfully when she was gifting a large amount to her mother. right? So yes, it works on other family members too, not just your children, right? That's a tax tip, okay? So make sure that you are giving together. If you are married, you can give more without having to pay that tax, right? The next thing that we're going to talk about is the lifetime gift tax exemption, okay? So if you want to transfer more substantial assets, fear not, you can do it, okay? So we have a lifetime gift tax exemption, all right? So as of 2023, the lifetime exemption amount is set at $11.7 million per person. Again, much like the gift tax exclusion, right? This means that the person given the gift is the one that has to pay the taxes, right? Not the recipient, okay? So this means that you can gift up to $11.7 million over your lifetime without incurring any gift tax, right? So remember, this exemption is per person, right? So if you are married, you and your spouse can double that amount to a whopping $23.4 million. All right, y'all can give together, right? And it's the lifetime gift tax exemption. Now, the strategy could be especially helpful with wealthy people, right, who have large estates and they want to give to persons without a hefty tax bill, right? So remember, that's another way for you to save big on that tax liability, okay? The next one that we're going to be talking about is direct payment of medical and educational expenses, all right? So last week we talked about the 529 plan and how you can put away tax-free dollars, right, for your children's educational purpose. But guess what? You can also gift that, okay? So you can, another smart option, sorry, I'm getting tongue-tied, is to directly pay your children's medical or educational expenses. So transferring the money for these purposes is a gift tax free option as long as the payment is made directly to the medical or educational institute. Okay, so the institute, it has to be made directly to the medical or educational institution. Okay, so it's no hello, Billy calls you and say, "Hey mom, I got this huge medical bill. I need you to transfer $500 to my account so I can pay it." Okay, it doesn't work like that, okay? How it works is you can transfer that money to the actual institution, all right? And $500 is low. So let's say he calls and says, "Hey, I have this $14,000 bill that I want you to pay." All right. So make sure that you are paying it to the institution and not directly to Billy. All right. So this is a great way to help your children financially while avoiding any potential gift tax headaches. All right. And then another gift tax strategy that we want to talk about is qualified personal residence trusts. All right. Now, we're going to dive into this more advanced option, y'all. This Qualified Personal Residence Trust, or QPRT for short. This allows you to transfer your primary or secondary residence to your children at a reduced gift tax value. Right? Now, by doing this, you can potentially remove the value from your estate, reducing future estate tax liability, but be sure to consult with an estate planning professional for guidance on this option, all right? So this is something that I even usually outsource to people, right? So I want you to tune in next week because guess what? We're going to have an estate attorney on deck and she is possibly going to be explaining this strategy, right? Or strategies like these. So come prepared with your questions, okay? And then the next one and our final is our irrevocable life insurance trust. Okay, so the irrevocable life insurance trust, right, is allows you to transfer a life insurance policy to an irrevocable trust, which removes the policy's death benefit from your estate for estate tax purposes, all right? So this can be an effective strategy for passing assets to your children tax efficiently, okay? Again, we will have an estate attorney here to do a deeper dive into any estate questions that you may have. But the key to remember here is that the term irrevocable means that the insured cannot change or undo the trust after its creation. All right. So those last two, a little more complex. That's why we're going to have a professional on that. So come prepared with your questions. All right. So let's do a recap. All right. For the 4 gift and tax strategies, we talked about the annual gift tax exclusion, which is $15,000 per person. So if you're married, that's 30. Okay. We talked about the lifetime gift tax exclusion, which is $11.7 million per person. We talked about the direct payment of medical and educational expenses. We talked about the qualified personal residence trust. And then last but not least, we talked about the irrevocable life insurance trust, right? So those were the 5, gift tax strategies, okay? And so there you have it, folks. Just a few tax smart options for transferring assets to your children while avoiding the gift tax trap, right? So remember, tax laws can change and the individual circumstances do vary. So it's always wise to consult with a qualified tax professional like myself to determine the best approach for you and your unique situation, because everybody's situation is different, right? It's not a cookie cutter, one size fit all type thing when it comes to tax planning and tax strategizing, okay? So if you found this information valuable, don't forget to like this video, subscribe to our channel, hit that notification bell so you can stay updated on all things tax related, right? Also, make sure that you leave your questions and comments below and we'll be sure to address them, okay? Also, you can follow us on LinkedIn where we share more tax tips and some informative articles. And finally, if you are looking to use our strategies and jump on a tax strategy call with us, visit our website. Okay, so we can book that tax strategy call with us. We would love to learn more about your situation and devise a plan to get you to start saving thousands, right? So again, thank you so much for joining us for tonight's episode of the Tax Takeover. I hope that you found it informative. Please make sure that you are liking and sharing because we want to get this good content out to everybody. Remember, I said tax planning is for everyone. You can do it no matter where you are on your financial journey, right? So until next time, you all have a blessed and happy Tuesday. And again, happy tax planning.